Hi everyone, thanks for checking out this video. Some of you may have just got your brokerage account set up on TD Ameritrade, Interactive Brokers, eTrade, or whatever, and they may have granted you a so-called margin account. With a margin account, you can buy more stocks than the capital you put in, since to some extent the stocks you buy are your assets and can be used as collateral so that you can borrow money from your brokerage to afford those stocks you have already bought. The point I want to make in this short video is that one needs to be very careful with investing in securities like stocks with borrowed money, or more technically, with leverage. It is very tempting to do, but if you are not careful, you could lose all your money. Because leverage magnifies not only profits, but also losses. And returns are not symmetric. Once you lose money, it's very hard to get it back. In fact, if you ask some famous long-term investors like Warren Buffett, they would tell you that's one of the stupidest things to do. To quote his partner Charlie Munger, there are three ways to go broke: liquor, ladies, and leverage. An outdated saying, of course, because there are more and more women in finance in this day and age, and in fact they are probably doing better than men. But you get the idea that they really don't recommend investing with leverage. I want to take a more quantitative look at this warning. I'll use SPX as an example. Looking at the recovery since the crash in March 2020 due to the COVID pandemic. From low on March 24th, 2020 to high on May 7th, 2021, SPX rallied 89%. If you were so lucky to call the bottom and invested $1,000 at the low, you would have made $890. If you had such high conviction and decided to use a leverage ratio of 2, meaning you borrowed $1,000 from your brokerage, you could have made $1,782, or use your own capital as the base, you would have made 178%. If your brokerage allowed you to borrow more money, which is unlikely, but let's just assume they did for some reason, and you were able to use leverage ratio of 3, then you would have made 267%, or in other words, you would have almost quadrupled your initial $1,000 capital. Very attractive, right? Now let's look at another period, the period leading to the recovery, the crash. From the then all-time high on February 19th, 2020 to the low on March 24th, SPX lost about 34%. If you were so unlucky to have invested $1,000 at the high, you would have lost 34%. But if you were, again, using a leverage ratio of 2, then you would have lost twice of that. And if you were using 3, then you would have lost all your money. But of course, the chances are your brokerage would have already liquidated your account before then, since it would have hit the margin call. So you see, investing with leverage is very tempting because it magnifies the potential profit you could make. Who doesn't want to make more money, right? However, it also exacerbates losses. And in fact, it's almost guaranteed that your account would be wiped out if you continue to invest with leverage, unless you are one of the very few lucky ones who know when to get out. In fact, leverage played a critical role in some of the epic failures in history, such as the collapse of long-term capital management in 1998, and most recently, Akigo Capital. Okay, thanks for watching. Hope this is helpful and hope to see you again next time.